Welcome to our channel. Today we're diving into Nvidia's recent second quarter earnings report and why it didn't quite hit the mark with investors. Listen, Nvidia has been a Wall Street darling for years now, and for good reason. Their chips are the engine behind the artificial intelligence boom, and everybody wants a piece of that action. But even the best companies can stumble. And that's what we're seeing here. Now, I'm not saying you should dump your Nvidia stock just yet. What I am saying is that we need to understand why the market reacted the way it did. We're going to break down the earnings report, go over the numbers that had investors scratching their heads, and look at the bigger picture to see if this is a buying opportunity or a sign of trouble ahead. So buckle up, because we're about to dissect this thing like a frog in a high school biology class. All right, let's get down to brass tacks. On the surface, Nvidia's second quarter earnings weren't bad. In fact, they beat analyst expectations on both the top and bottom lines. Revenue was up, earnings per share were up, everything seemed hunky-dory. So why the long faces on Wall Street? Here's the thing, this market is all about the future. Investors aren't buying stocks based on what a company did yesterday. They're buying based on what they think will happen tomorrow, and when it comes to Nvidia, the future is all about artificial intelligence. Now, Nvidia's data center business, which is where they sell those powerful AI chips, did see impressive growth. But it wasn't the kind of blowout growth that analysts were hoping for. Remember, expectations were sky high for Nvidia going into this earnings report. Anything short of a home run was going to disappoint. And that's exactly what happened. The market was expecting Nvidia to hit a grand slam, but they only managed to double. Don't get me wrong, a double is still a good hit in baseball, but when you're a company like Nvidia, with a stock price that's been on a tear, investors want to see you swing for the fences every single time. So, while the overall earnings report wasn't bad, it wasn't the earth-shattering performance that everyone was expecting. And when you're dealing with a high-flying stock like Nvidia, even a slight miss can send the share price tumbling. Let's dig a little deeper into the numbers, shall we? One metric that had investors worried was Nvidia's gross margin. Now, gross margin is a measure of profitability. It tells you how much money a company keeps from each dollar of revenue after accounting for the cost of goods sold. In Nvidia's case, their gross margin came in slightly below expectations. This suggests that the company might be facing some pricing pressure or higher costs. Now, this could be due to a number of factors, such as competition in the AI chip market or rising raw material costs. Another metric that raised some eyebrows was Nvidia's guidance. Guidance is basically a company's outlook for the future. It's where they tell investors what they expect to earn in the coming quarters. And let's just say that Nvidia's guidance wasn't exactly music to investors' ears. They projected slower than expected growth for the next quarter, which suggests that the demand for AI chips might be cooling off a bit. Now, this could be a temporary blip, or it could be a sign of a broader slowdown in the AI market. Remember, the market hates uncertainty, and when a company like Nvidia, which has been a beacon of growth, starts showing signs of weakness, it can make investors nervous. Now, it's important to remember that Nvidia's earnings report didn't come out in a vacuum. The broader market has been on edge lately with concerns about inflation, interest rates, and a potential recession. When the market is in a risk-off mode, as it is now, investors tend to be less forgiving of any bad news. They're quicker to hit the sell button, even if the news isn't all that bad. Think of it like this. Imagine you're at a party and everyone is having a good time. Then someone spills their drink. No big deal, right? People laugh it off and the party continues. But now imagine that same scenario happening at a funeral. That spilled drink is going to be a much bigger deal. People are already on edge, and the slightest mishap can set them off. That's kind of what's happening with the market right now. Investors are on edge, and Nvidia's earnings, while not a disaster, were enough to spook them. So, what's the bottom line? Is Nvidia doomed? Of course not. This is still a fantastic company with a bright future, but it's a reminder that even the best stocks can go through rough patches. The key is to not panic. Don't make any rash decisions based on one earnings report. Instead, take some time to digest the information, do your own research, and decide if Nvidia is still a good fit for your investment portfolio. Remember, investing is a marathon, not a sprint. There will be bumps along the way, but if you believe in the long-term story of a company, then don't let short-term noise shake you out of a good investment.